Today we are going to break down exactly what is happening in the United States silver market right now, using fresh 2026 data, real price levels, confirmed macro drivers, and forward-looking projections. If you are trading silver, investing in physical metal, or positioning in ETFs and futures, this update is critical because volatility has expanded and price structure is changing rapidly. As of the latest U.S. session, COMEX silver futures are trading in the high $80 range, fluctuating between roughly $88 and $91 per ounce after recently breaking above the psychological $90 barrier. This move followed a strong rebound from earlier 2026 lows and marked one of the most aggressive upside expansions in the precious metals complex this year. The XAG/USD spot market is mirroring futures strength, although short-term pullbacks have appeared whenever the US dollar strengthens intraday. The recent surge has been widely covered, including analysis from MarketWatch noting that silver has recently outperformed gold as investors rotate into higher beta precious metals during periods of trade tension and geopolitical uncertainty. That relative strength is important because it signals risk appetite inside the metal space rather than simple defensive allocation. Now let us step back and analyze what is structurally driving this market. First, the macro backdrop. The Federal Reserve remains central to silver's trajectory. Expectations for policy easing later in 2026 have increased following softer inflation prints and moderating labor data. When real yields compress or are expected to decline, non-yielding assets like silver become relatively more attractive. Unlike gold, however, silver carries a dual identity. It is both a monetary metal and a high-beta industrial commodity. That means it benefits not only from falling real yields, but also from growth expectations in manufacturing, green energy, and advanced technology. Second, industrial demand remains historically elevated. Solar panel production continues expanding in the United States and globally. Electric vehicle penetration is rising. Data center expansion tied to artificial intelligence infrastructure requires high conductivity materials. Silver's role in photovoltaics, semiconductors, and high-performance electronics keeps baseline demand strong. Even if monetary flows fluctuate, this industrial floor provides underlying support. Third, inventory data is tightening. COMEX registered silver stocks have declined significantly from late 2025 levels. Lower exchange inventories increase sensitivity to delivery demand. When speculative longs and physical buyers compete in a tight environment, price spikes become more aggressive. We saw similar behavior in prior commodity cycles when warehouse stocks approached critical thresholds. Fourth, geopolitical risk. Ongoing trade policy friction and Middle East instability have created episodic safe haven flows. Recent coverage from finance magnates highlighted silver breaking above the $91 level, while gold lagged, underscoring capital rotation into silver during a risk rebalancing phase rather than pure crisis hedging. Meanwhile, commentary from the Economic Times emphasized silver's rebound of roughly 18% from its 2026 lows, pointing to structural catalysts rather than temporary speculation. Now let us examine the technical structure. On the weekly chart, silver has established a clear higher high and higher low sequence since the first quarter bottom. The breakout above $85 was technically significant because it invalidated the prior consolidation range and triggered systematic buying from trend-following funds. Momentum oscillators remain elevated, but not yet at historical blow-off extremes. That means the rally is strong, but not statistically exhausted. Immediate resistance sits in the $93 to $95 band. This zone corresponds with projected extension levels from the prior range breakout and coincides with psychological round number supply near 95. A sustained daily close above 95 could open the path toward triple digits. However, it is critical to understand that markets rarely move vertically without retracement. Support now begins in the 86 to 88 region, which previously acted as breakout resistance. If silver pulls back into that area and holds, it would confirm structural strength. A deeper retracement toward 82 would still preserve the broader uptrend, but would signal short-term deleveraging. Volatility metrics have expanded sharply. Implied volatility in silver options has risen alongside price, reflecting uncertainty about continuation versus exhaustion. Historically, when silver volatility spikes during an uptrend, pullbacks can be sharp but short-lived, unless macro drivers reverse. Now let us address the most common question. Is silver going up or down from here? In the very short term, over the next 1 to 3 weeks, consolidation risk is elevated. After rapid appreciation, profit-taking by leveraged longs is natural. If the US dollar stages a temporary rally, or if Treasury yields tick higher on stronger economic data, silver could dip toward the high 80s. However, in the intermediate term, the bias remains upward unless one of three variables shifts materially: sustained dollar strength, hawkish Fed surprise, or collapse in industrial demand projections. At present, none of those conditions are dominant. Large institutional forecasts reinforce this view. Analysts cited by this street discussed upward revisions in silver outlooks for 2026, reflecting both deficit projections and capital rotation from gold. While extreme targets above $130 represent tail scenarios, even moderate institutional forecasts cluster well above the current trading range. It is important to separate hype from probability. A move from $90 to $100 requires roughly an 11% increase in silver's historical volatility context. That is entirely feasible within a quarter if macro tailwinds align, but sustainable trade above 100 would require either accelerating industrial demand or clear monetary easing from the Federal Reserve. Now let us analyze the dollar relationship. Silver typically trades inversely to the US dollar index. Recently, the dollar has shown mixed performance, weakening against certain currencies while holding firm against others. If the dollar weakens materially due to rate cut pricing or widening fiscal concerns, silver could extend gains rapidly. Conversely, a sharp dollar rally would likely cap upside momentum temporarily. We also must monitor gold-silver ratio dynamics. The ratio has compressed during this rally, meaning silver is outperforming gold. Ratio compression often occurs during bullish commodity expansions. If the ratio stabilizes at lower levels, it would indicate structural strength in silver rather than speculative distortion. Let us consider supply. Global mine production growth remains limited. Many silver mines are byproduct operations linked to copper, zinc, or lead extraction. Therefore, silver supply expansion depends partly on base metal economics rather than pure silver pricing. This creates a lag in supply response during rapid price appreciation. Structural deficit conditions have been discussed across commodity research channels, and if those deficits persist through 2026, price floors will likely rise. Exchange-traded funds tracking silver have also seen renewed inflows. Investment demand adds an additional layer on top of industrial usage. And when ETF inflows coincide with low inventories, volatility intensifies. Now let us construct scenario analysis. Scenario 1, bullish continuation. The Federal Reserve signals dovish bias. Dollar softens. Industrial data remains resilient. COMEX inventories decline further. Under this environment, silver breaks 95, consolidates above it, and tests 100. Momentum funds re-engage aggressively. Scenario 2, controlled consolidation. The Fed remains neutral. Dollar stabilizes. Industrial growth remains steady but not accelerating. Silver oscillates between 85 and 95 for several weeks, forming a base before the next directional move. Scenario 3, corrective pullback. Strong economic data pushes yields higher. Dollar rallies sharply. Speculative longs unwind. Silver retraces toward 80 or even mid-70s temporarily before structural buyers re-enter. Probability weighting at this moment favors either scenario 1 or 2, not scenario 3, unless macro data surprises meaningfully. For traders, risk management is critical. Silver's volatility is historically 2 to 3 times that of gold. Position sizing must reflect that reality. Breakouts can be powerful, but reversals can be equally sharp. For long-term investors accumulating physical silver, current conditions still align with a structurally supportive backdrop, though staggered entry is prudent to mitigate short-term swings. Now let us address sentiment. Retail participation has increased, but we are not yet at euphoric extremes seen in prior speculative episodes. Search trends and retail trading volumes have risen, yet institutional positioning data does not suggest an overcrowded long trade at this time. One more critical variable is energy pricing. Mining costs are energy intensive. If oil and electricity costs rise, marginal production costs increase, indirectly supporting higher price floors. Looking forward into the second half of 2026, much will depend on confirmed rate policy direction and global growth stabilization. If growth moderates but does not collapse, silver's industrial demand remains intact while monetary easing supports investment flows. That is the ideal bullish alignment.